right. So we're first going to start focusing on chapter 11. That was the first chapter between chapter 11 and 3. First things first is I'm going to go over the definition of a corporation, and then I want y'all to tell me some advantages, and then after that, disadvantages. So first off, corporation is an entity that is separate from its owners, which is a separate legal entity. The owners of a corporation are called stockholders or shareholders. Corporations can be publicly traded or privately held. Privately held corporation does not offer its stock for public sale and usually has few stockholders. Public corporations offer its stock for public sale, meaning the stock is sold on the public market, such as the New York Stock Exchange. A corporation is created by filing a charter with the state government. Investors then purchase a corporation stock, mint as stockholders, and elect a board of directors. So, everything's working. What are some advantages?
Limited liability.
Limited liability. Stockholders are not liable for corporate actions or debt. We got 6 in total, so that's 1. So we got 5 more.
Continuous life.
Continuous life. A corporation life is indefinite because it is not tied to the physical lives of owners. Those things are created to outlive the people that started it. Separate legal entity. A corporation has many of the same rights as a person. It takes actions through its agents, who are the officers and managers of the company. What else? Actually, I'm going to start writing these on the board as well.
Easier capital accumulated.
Easier capital accumulated. Right. Easier capital accumulated. Corporation can raise more money than other forms of businesses because of the ability to sell stock. We got 2 more left.
Lack of mutual agency.
Lack of mutual agencies. Stockholders who are not an agent of the company cannot bind the corporation to contracts. All right. What else? Yep, transferable ownership rights. Ownership is evidenced by shares of stock. Ownership is easily transferred through sale of stock and has no effect on operations of the company. All right, so what are going to be some disadvantages?
Double taxation.
Double taxation. Otherwise known as corporate taxation. Corporations pay additional taxes and other types of entities may not have to pay. Being a separate taxable entity can lead to double taxation. What is one more? There's only one more.
Regulations.
Government regulations. Corporations must follow state and corporation laws. All right. So now that we have that, let's run through the advantages and disadvantages of issuing equity. So we got two advantages of issuing equity, and we got them. So that's going to actually be a disadvantage, but I'll put that over here. More people who has a piece of their finger in the pie, the more money it gets. So, anyone has the other disadvantage? No tax incentives.
Working on it, so one should be.
Thank you.
Okay.
Then we have advantages. What are going to be the advantages?
We've actually got one more that wasn't listed and wasn't discussed in class. If you are a stockholder in a corporation and you file your regular taxes, generally you're going to have to pay a CPA to do more paperwork. And if you're not receiving dividends, you take a loss every year in which you have to pay towards your personal income tax.
True. So that is usually to the stockholders and not the corporation, because the corporation doesn't have to deal with that. As for the stockholders, yeah, we have to take that bite.
Right. So you better find that it's you know, preferred or private stock that you know is going to gain the dividends to at least cover your tax costs.
Oh, of course. All right. So the advantages are ease of raising capital and dividend flexibility. Because everyone wants to pay for stock, and you never have to actually, kind of backing off of that, you never know if the corporation is actually ever going to pay you a dividend. So before we start, getting into the stock bits itself, does anyone have any questions about corporations or distributing equity? Or do you guys feel pretty good about that? Pretty good? Good to hear. So we're going to start getting into describing this. So I'm putting the form out. I'll actually start giving some definitions to what they are, but you guys are going to have to tell me if it's authorized, if it's issued, if it's outstanding, or if it's treasury. So first things first, whole kit and caboodle, right here, total amount of shares of stock a corporation can issue allowed by its charter. So what was it? Authorized stock. So what it was the total stock that a company is basically allowed to issue. So it doesn't mean it's issued yet. It could still be unissued, but the big thing is that it's the total amount that we're allowed to give out. We're going to take it down a bit. We're going to say, all right, what is the shares of stock that have been issued by the company?
Outstanding.
Not outstanding, but you're close. You step ahead. Huh? It's issued. The reason why it's issued and not outstanding is the fact that we're talking about what's been issued. Outstanding stocks, there's a specific reason they're not just called issued stocks. And we're going to get into that in a quick second. So, since we have outstanding stocks on the table, who owns outstanding stock? Who specifically owns outstanding stock? Stockholders. So stockholders are the ones that hold the outstanding stock. We got this empty blank space here. What is this part? Treasury. Who owns treasury stock? And why is it different than outstanding? The company or the corporation itself is the one that owns the treasury stock. Why is that different than outstanding? I can't hear you. Can you speak up a little? It is owned by stockholders, but what is the difference that it is issued? It is issued, but it's the fact that we repurchased it. It's still issued, like it's out in the market. But the thing is, we get to resell it at a fixed rate instead of the market rate. But the reason why it's very different than outstanding is the fact that treasury stock, one, doesn't receive dividends. Two, what is typically its par rate? Is it going to be the same as common stock? Welcome in. So is the par rate for treasury stock, is that ever going to be the same as the par rate for common stock?
Yeah.
How do we determine the par rate for treasury stock? Not what it was sold at, what it was bought at. So if we're going to get into this more when I start giving out some problems, but the treasury stock itself, if we bought it back for like $30, when we resell it for whatever set amount, that treasury stock will not lose that dollar value. That is technically its par value. We're not really ever going to call it its par value, but it's the best word that I have to kind of relate to it, towards it, because basically every share of that treasury stock is every piece of what you buy. So one treasury stock that's worth $30, when you resell it into the marketplace and you get rid of it, you're going to treat that treasury stock as if each one has been sold at $30, no matter the cash that you got. Any questions on any of this? No? Awesome. All right, let's start getting into common and preferred stock. We're just going to get into the descriptors of it. And then we're going to just start getting into some practice problems. So one big thing, common and preferred stock, where are we going to find our common and preferred stock in this little chart? Nope, this is all an issue. This is basically in the void. So it's not going to be everything else. Where is common stock and preferred stock located? Not treasury, that's what we hold. It is held in stockholders' equity. You're not wrong, but when we're talking about authorized, outstanding, issued, and treasury, it's technically authorized, issued, outstanding stocks. So common stock and preferred stock are going to be our outstanding stocks. So there's a couple big difference between common and preferred. Can y'all give me some of the differences between common or preferred, or just tell me which one has what? Preferred gets dividends first. All right, what else?
Preferred stockholders don't have like say in like corporation decisions.
You're right. So no voting rights, and we're gonna put voting rights over in common stock. What else?
Preferred stocks get assets from liquidation before common stock does.
Yep. So we're going to tie this over towards the first to get dividends. They also get a fixed amount of dividends. Can anyone give me the formula to figure out the fixed amount of dividends for preferred stock? So what's gonna be the formula to figure out the fixed amount of dividends that preferred gets? This will be important for the test, so you will have to know this. Yes, perfect. So it's going to be, and we're gonna simplify the words a little. It's shares times par times percent. This will be important for some of the practice problems as well. But that is how to find those, welcome in, fixed dividends. So now that they've fixed this up, I'm gonna real quick sign into the. All right, well, that's loading up. Yes.
What is that percent? Equal, like, what is that?
It's only for preferred stock. Whenever you see a preferred stock problem, you're always going to get a percentage with that. That percentage is only ever used and is very, very specific towards dividends. And will only be used to figure out how much the dividend they get is. So you're only, that's why you have a percentage here and will only be used for that moment. Does that make sense? Awesome. Yeah, of course. We're not done yet, though.
Well, I'm gonna wait then. Common stock can sell their stock.
Right to sell and dispose. How much dividends does common stock get? Is it ever set? Nope. What do they typically get? Huh?
Is it the earnings?
So it is less than preferred. Well, no, it's not always less. The thing is, it's never always less. How much dividends common stock gets is always going to be left over from the fixed amount that preferred gets. The thing is, with the fixed amount, let's say if you get a 90,000 dividend, the company's giving out 90,000 dividends, preferred stock has gets a cut of 60,000, common stock's going to get 30,000. Now, if preferred stock instead is promised a 20,000, common stock's going to get 70,000. So they're not promised what amount of the dividends, but sometimes they can basically make out like bandits at the end. Or sometimes they're going to be scrapping for pennies, if any, because there is also the chance that if you give a 90,000 dividend and let's say preferred stock is promised 100,000, common stock ain't getting nothing, and they just have to move on with it. So let's see. There is one more thing for common stock. So the last thing in common stock is that we get a purchase proportionate share of any common stock later issue, or otherwise called preemptive rights. Basically, if I own common stock in a company and they suddenly say, hey, we are now going to authorize more shares or issue more shares, you get first pick. I get to basically say, all right, I'll take your offer. I'll get 10 more shares because I get the first pick of common stock now because I have my foot in the door. Bless you. So we're going to call this preemptive right. And right under it, All right. So to kind of sum this up, common stock, they typically don't get the better half of the deal in money wise, but otherwise towards the company, they get to basically have more power. I like to say common stock has power, preferred has the money. Common stock gets voting rights, right to sell or dispose stock. They get the leftovers dividends from preferred stock, which sometimes can be a great boon and sometimes can basically make them feel like they're cheated. And last is they got the preemptive right to purchase proportionate of any common stock later issued. Preferred stock, they have dividend preference, meaning they're paid first. If the company liquidates, they get first say in the assets. They do not have voting rights and they get a fixed amount of dividends. So like I said, sometimes they may be making more of the pie because they'll get most of the dividends. But at the end of the day, there is also a chance that because of how much dividends and how much preferred stock they have, they might get a very big cut. All right. I'm going to check how the computer's doing. While you guys, if you guys need to write anything else down, take a picture, anything like that. And then I'm going to start setting up some practice problems for us to figure out how to find how to make journal entries for common stock, preferred stock, and all of the above. Just give me 1 second. There we go. There we go. All right, any questions on common stock or preferred stock? All right. So I'm going to start throwing down some practice problems. What I'm wanting from y'all is to write the journal entries for these. All right, I'm gonna give you guys 3 minutes to go over this. If you have paper, feel free to do that. We also have markers at the front. We have erasers at the front as well. Give y'all about 1 more minute.
What's the last thing, the very last at the
It
bottom?
says $50 share at a $20 par, 9%.
Oh,
So,
9%.
here, let me. I did not make things as bad as I wanted. We'll do that for now. All right, let's start going through this. Real quick, I'm gonna turn off everything but Zoom. There we go. Move these to the side for now. Oh, I guess I zoomed out way too much. So we're just going to take it like this. All right. So what's gonna be my journal entry for number 1?
Is it cash, 60,000?
I see how you got 60,000 because that 8 looks like a 0, correct?
That's an 8?
That is an 8. Like I said, it looks kind of like a 0, so I understand. No, you're good. But I see I see what you did. So you're right. If it was a 0, it would be 60,000 for cash. Now we're debiting cash or crediting cash? Debit cash. The value for this instead is 76,000. So what else are we doing here? Common stock debited or credited? How much? You're right. $11,400. Are we done here? No. What else is here? Paid in capital. And how much is that? 64,600. Perfect. All right, next one. The company issued 5,460 shares of preferred stock at a par of $50, 8%, and at a market price of $100. Yes. Yeah. Cash is 546,000. So what else is here? $27. So that's what I got. Yeah, because 50 times 5,460. Oh. That's where you got it. No, you do not, because what is that decimal important to? And what is it only important to? Dividends. So you will never use that percentage to figure out the value of your stock. The value of preferred stock is always going to be 50 times the share. this is only ever used for dividends, and it's always going to be put like this on your test as a red herring. It'll trick you into using it, but it's one of those values, depending on the question that's being asked, that can be completely ignored. So, what's the last account we need to put down? Bank capital. So, we're multiplying the 5,460 times 50. Because that's what the par value is. See, this is a case of my handwriting's very bad and I apologize. All right. As long as you know how to get the answer, that's the important part, because the handwriting will not be wrong on the test. So we have our pick account. What's going to be the value of it?
283,000.
Yep.
Yeah, it's good.
So we now sold 2,200 shares, $1 for $18 a share. Yes. Mhm.
How do you know which stock?
So when it's not, the biggest difference between common stock and preferred stock is going to be this percentile. If you're typically just said we sold shares and there's no percentile there, automatically think it's common. That's kind of why I changed the wording up for all of these for this specific reason. That way we're able to figure it out. So it is common stock. And what did you say the answer was? 2,200. And what's our pick account? 37,400. Awesome. We sold 90 shares of $80 par value preferred stock for $10,000 cash. So cash of 10,000. Mm-hmm.
200.
Awesome. All right, we're on the last two. Any questions so far? Is it starting to make some sense? Oh, you mean the last one's in a different color?
No, why is the number 4 like why is it
That's all good. Sometimes, so I know some classes teach it as PIC, some classes teach it as ACIP. So they both mean the same thing. The only difference is that ACIP means additional paid in capital, while paid in capital means paid in capital. So there's really no difference between them.
So the second one is preferred stock, right?
Yeah, the 77,200 is preferred stock. So number 5, we common stock was sold for $9,000 cash with part of $5 in 2,000 shares. Anyone else want to give a shot at it?
Cash 9,000.
Cash 9,000. What else we got for this?
A pick gonna be debited.
Oh, I realized I made the mistake on this one.
Yeah, the
90,000.
yeah.
We'll make it 19,000. That's on me.
So then common stock would be 10,000.
Yeah. What does that mean for APIC?
It is 9,000.
All right, awesome.
I have a question.
Yes.
Could there ever be a case like if they sold it for 9,000, would that ever happen? Like where the stock is less than what they sold it for?
As far as I don't know in the real world, but as far as in accounting classes, you're never going to see that. That's why instead of going with that, I changed it because you're never going to see common stock being sold above the market rate. The par value will always be under the market rate. Yes,
You gotta think it too, are you gonna be here from till 4 to 3?
till 4. So today's till 4. It's next Monday that we're there till 3. So don't worry. And also, we are recording this as well, and this will be posted up by 5 tonight. I like to hope. Worst case scenario, 6. So, got the last one here. Preferred stock was sold for $50 a share at $20 par, 9%.
Is it cash or loan?
Yeah. Oh wait, did I never give a par value or share? Ah. So yeah, we'll just keep going with like 10,000. That would mean it would be 2,000 shares. $200 shares, I mean. The issue of making these up on the spot. There we go. That looks correct. Correct me if I'm wrong, please. What else is happening here? Have a good one, good luck.
Thank you, I'll be back.
See you then. Preferred stock, how much? What was that? 4,000. Our pick will be 6,000. Besides my own mistakes, anyone have any questions about any of this? Or is this all kind of making sense?
I know you said this earlier, but the percent you would ignore in every question.
Yes. The big thing you're going to have to deal with percent is finding out the dividends. So actually, let's figure out the dividends for some of these preferred stocks. This is a great segue. We're just going to run through. How are we going to find the dividends for preferred stock for number 2? Awesome. So what's that number going to be?
$21,840.
21,840. So that's going to be the dividend. I'm going to put that in this color. There we go. So what about for number 4? Oh, I didn't give a percentage for that one. We're going to throw down a percentage. 7%. It's all working. Thank you. 7%.
Oh, no, never mind. I was doing the wrong one.
That's all good. 504. All right. What about number 5? And I did put percent for that one.
Oh, the last one?
Yep.
360.
360. So we're going to keep going to the side here. We'll talk more about dividends, but I want to see if you guys are able to record some dividends first. We'll say we're going to be giving a 20,000 dividend. I'm going to give you guys 2 minutes. The company dividend is 20,000. I want you to tell me how much common stock gets, how much preferred stock gets, and then give me the journal entry for the date of record. I mean, not the date of record, but not just the date of record. Let's see. Give me the journal entry for the date of declaration, the date of record, and the date of payment. I'll give y'all 3 minutes because I threw a lot at y'all. How do you do it? That's okay. So
What's our percent?
what we're doing is taking these dividends amount. So this is our preferred stock dividends. I need you to figure out how much does preferred stock get out of 20,000. How much common stock gets out of 20,000. And then I'm gonna need, and I'm gonna put it to the side here actually. Journal entries for the date of declaration. Date of record. And date of payment. And we'll just run through this and go over this in about 3 minutes. So take a moment if you need to look at your notes. This isn't a closed book quiz. You guys are free to look at whatever you need to. You don't need a percent because you already figured out the dividends.
Oh, so we're using the same.
Yep, we're using the same problem. So this is going here. This is kind of already here, but that's there. And this amount. So we've already found a preferred stock dividends for each 3 scenarios. You're just using this information to figure out your journal entries and how much each one is getting.
Like, how much are we, like, with the first stuff, like?
So preferred stock is going to be for the questions that we figured out before, where we figured out each dividend that preferred stock would be getting. We've already done the percentile to figure out, okay, how much preferred stock gets. So you're going to use this dividend.
So like the top 3 boxes on like main, like, are we putting that for like the first, like for like number 3?
So number 3,
Or wherever the like last first box is? Like, no, number 2.
we'll do number 2 real quick for at least figuring things out, because one of these is a trick question and I want you all to try to see if you do. So the dividend that we found out for preferred stock has already been done for us. It's 504. What does that mean for common stock? How much does common stock get? Yep, the difference between 20,000 and 504. So common stock gets the full 19,496. So that's how to do that part. Do y'all have a good understanding of how to do the journal entries, or you guys want to go through that as well?
Let's go through it.
Let's go through it. All right. So date of declaration. What's going to be our journal entry? Are we paying it or are we just declaring it?
Declaring.
So when we declare our dividend, are we now liable for it? Yes. The reason why is basically in this case, as a company, our word is law. when we declare dividends, meaning we cannot back out of it. The moment we declare a dividend, we are legally obliged to pay it. So what's going to be my debit? Dividend. What's going to be my credit? Huh?
Oh, never mind.
Not returned
Dividends
earnings.
payable.
Dividends payable? Yeah, dividends payable. Now, how much is my dividend going to be? What number am I using from the three that we kind of set here? 20,000. All right. Now for the date of record, what journal entry do we make for that?
No journal entry.
No journal entry. There is no journal entry at all. Date of record is technically what we did here. This is our date of record where we say, all right, you get that piece of the pie, you get that piece of the pie, be happy. All right. Now, what's going to be the journal entry for the date of payment?
Oh, wait.
Payable, debited, and cash.
All right. How much? 20,000. Doesn't change. All right. I'm going to give you guys a minute to look at 1 and 3. See if you guys can do that one on your own. And then we'll run through it.
So is it you never, like, we're never gonna learn the data report?
Data record is no journal entry at all. It's just this little mathematical process. Yes.
So that's
It is, but can they get that much? So this is how much technically they're promised. We're saying, all right, if we give a dividend, you will get a max of 21,000. That doesn't mean you're going to get the whole thing. It only means that that is the ceiling. You are promised this amount of the dividends first, and then after, you're done.
Oh, yeah. So like, there's common stock is zero.
Common stock is 0. And what's going to be preferred stock?
20,000.
20,000. Now, question. I know it changes year to year, so I just want to make sure first. Do you guys go over cumulative and non-cumulative for preferred stock?
Went over it
Briefly, but did she say it's going to be on the test?
not to us.
Not to you? And I don't believe Jaeger either. So,
I know I'm surprised we're taking that test tomorrow.
As far as we know.
oh yeah, no, I don't have all the resources I wanted to.
Yeah, I don't think
No.
she knew that there was a test tomorrow.
Yeah, no, I literally spent this whole the 2 hours in the morning cranking out like I think 4 blue kits because I had nothing. I had it was just way too fast.
Yeah.
But we have 4 blue kits though, I promise.
100
Yes, I'm aiming for it.
So the cumulative and non-cumulative, that was like based on like the situation where it's like.
Yes.
21,000 was
No, she
code, but
didn't
like.
have it last night.
Will-
Yeah.
We'll run over it real quick after this, just in case, because it really is a simple concept, but we're not going to go too in detail. Yes.
Let the journal entries be the same problem.
Yep. Journal entries are the same. All right, now what's gonna be for the amount of preferred and common stock down here? All right, perfect. Any questions on any of this? Yes.
How did you get 19,096?
We're gonna move this because we don't need it anymore. We took 20,000 minus 504 because we already knew our preferred stock. So we took that.
I think she posted work on problems too.
I have them.
Is this one?
Is this on it?
Yeah.
Does that make sense?
Yes, so what about the top one then?
I'm sure it's what you do.
Then it would be 20,000 minus 21,000.
So the thing is, we can only give $20,000. We can't say you get a negative amount. That is the max number of dividends we're getting. Now, that means that preferred stock gets all of it. But we're gonna run over, and this is a great segue to talking about cumulative and non-cumulative. So, yes.
Sorry, one last thing.
Yeah.
Would we like do anything like a journal entry for the differences that we made?
This is data record here, no journal entry. All right, so we're gonna specifically look at this problem right here, because this is where we had that issue where our preferred stock was promised 21,840. These are promised 21,840. We are only able to give them a 20,000 dividend. Now, the thing is, depending on if the preferred is cumulative or non-cumulative, things happen next year. So this is year one. Year two, we're gonna make this little section here, and I'm gonna erase some of the math here. So in this section here, we're gonna call this little space here years. So, and we're splitting this in two spaces, right? On the top is gonna be cumulative. And this will be non-cumulative. I'm just gonna put non for now. Non-C. So for non-cumulative, know that non-cumulative basically means you get what you get and you don't pitch a fit. At this point, they have nothing to pass over to this point. I'm gonna make this a little bit thicker. Can y'all be able to read it on the big screen back there, or is it too light? It's all right? Okay, cool. So the thing is with cumulative, that difference we noted, we actually drag it forward. So we have this in arrears, and basically means we still owe them 1,840. Now, we're not going to put a liability, but we're going to make it in our notes in our date of record and say we still owe them this amount. Now, we're going to continue to split this up here. And we're going to say year two, we got a dividend of 40,000. So we know here for preferred stock, right off the bat, how much are they getting? 21,840. Now, that's for non-cumulative. For cumulative, what's happening? What do we have to do? Because are they just promised at 21,840? No? What else are they promised?
The stocks from that year, or not
The dividends.
Yeah.
Yep. So basically we add on. See, all right. That's how much we get. And again, common stock gets whatever's left over. So. No worries. Like I said, I'm just running over this just in case.
Wait, how did you get 3,000?
The big difference here, how we got this was 21. That was 21. 840 plus 1,840. That's how we got that 23,680. And now if we go over to year 3, both of these have nothing in arrear. And basically preferred stock, just once again, depending on the dividends, we'll say 30,000. We're not going to go through all of it, but we're just going to say that preferred stock is now back at 21,840. Any questions?
So how do they keep in mind that they just noted that they still owe 1,840 if it's cumulative? Like they don't make a journal entry for it or anything?
They don't make a journal entry. Instead, they have their data record book where they're just keeping track of it. So this is just something companies will manually keep track of.
Oh.
You won't have to know that for the test or anything. It's just fun to know. Yes.
I'm curious, why the amount of dividends like this?
It depends on how much a company gives. So literally the company gets to decide. It usually depends on how much they made in profit of a year. So if it was a great year, I'll decide to give like 30,000 dividends. Hooray, money, everyone. If it's a bad year, sometimes I might decide I don't want to give dividends. We need to keep the money in the company. We have to keep going. Dividends are basically just, it's not a promise to common stock or preferred stockholders. There's even companies nowadays that are actually utilizing the fact they don't have to give dividends. This is just fun knowledge, not really in the test, but like companies back in the day used to give a lot more dividends because they wanted to incentivize people to give money to their companies. So dividends are not a promise, they're just incentives. And we get to decide as a company how much we give. Does that make sense? Dividends are going to the people, the stockholders. Whoever holds that preferred stock, for each stock they own, they get how many number of dividends I think they get. So, From the company. This is also why we take it out of our retained earnings. We lower our retained earnings because technically we didn't retain it. We gave it. We said, here's your little money packet. Thank you for believing in us.
Thank you.
Yeah, of course. So, besides that, ignoring cumulative and non-cumulative, does this make sense?
Yes.
Cool. All right. So, we're going to backtrack a little bit. And we're going to go through some treasury stock examples. So, we're going to put that up. Cool. So I'm going to put 2 questions here. They're going to be 3 parts. Welcome in. Work on it as I'm writing it down because I'm going to give you guys just 3 minutes to work on this. And then we'll start running over it together.
Well, theoretically, it's not what I do. I'm gonna use some. That's in let's see now. Let's see now. I'm just, yeah, it is just me.
Yeah.
Oh, no, my computer.
I think it's okay.
I've put some fun wording, but hopefully this makes sense. I'm gonna give you guys 3 minutes. While y'all are working through this, I'm gonna go get some water, so. I'll be right back.
There's always stuff for issue. Or we I mean, right now we're feeling cash. Then I've been, okay, let's do cash. Then I think what it is. Yeah, yeah, this is gonna be what we did, we, Because it's an honest contract we are reissuing and it's on contract. Yeah, I've got to do it on my make sure you listen.
All right, I'll give y'all 1 more minute. All right, let's start running through this. So first things first, what's gonna be the journal entry for 1A? What's debited, what's credited?
Treasury is debited.
Treasury stock is debited, cash is credited. For how much? 120,000. All right, perfect. So 1B, we reissued 2,000 shares at $50 per share. Cash 100,000. So what was that? It wouldn't be 100,000. So treasury stock 80,000.
What? No.
So something very important to know is that the $40, the moment we buy that treasury stock, that $40 is the treasury stock par value. Meaning every treasury stock after is going to be calculated as treasury stock at that value. The reason why we do this is if it was 100,000, if we got to question 3, and that was still over the rest of the 20,000 that would remain in that account, our books would be incredibly off. So we keep it at that par value of $40 per share for all of the treasury stock that we sell throughout this problem. Does that make sense? Cool. All right, so what else do I have to do though? Additional paid in capital. So how much is that? Perfect. All right, last one. We reissued the remaining shares at $30 per share. Yes. Cash 30,000. Yep, we do have a debit to pick. The reason why cash is 30,000 is because we already got rid of 2,000 shares, so we only have 1,000 left. Mm-hmm. Yeah, 1,000 times 30.
Why wouldn't it be 40,000?
Because that's going to be for our treasury stock. This is the this right here is the cash value. Yep, it's how much people bought it for. So before we go to the PIC account, what's gonna be our treasury stock? 40,000. Nope. Yep. But does that answer your question of why it's 30,000, by the way? Okay, I just want to make sure before I keep moving on. It just hit me, I should have asked. All right. So any questions on the first set of problems? Perfect. All right. 2A. I purposely made some word choices for this. So, the company repurchased 1,500 shares of common stock at $62 per share. Still treasury stock. The whole thing about treasury stock, it's this. Repurchased. Company repurchased. That is the important part. If you see company repurchase, automatically think treasury stock. No matter the wording, you see company repurchase, just right off the bat, treasury stock, welcome in. So what's going to be the journal entry for this? Yep, and for how much? All right, so what next? Yep. Treasury stock, what was the number for that? 62, awesome. All right. Last one, we reissued the remaining shares for $20,000 in cash. What's happening? Wait. All right. Does this make sense? No?
Why are you debiting the 11?
The reason why we're debiting this 11,000 is because it's the difference between treasury stock and cash. So we take that 31 minus 20,000 equals 11,000. And because we know that our credits are heavier than our debits, we have to make up the difference by debiting the PIC or APIC account. It's the same thing up here, where again, we had 40,000 of treasury stock, we had 30,000 cash. Think of PIC, think of paid in capital as the plug-in account. It fits where it needs to. It's that it will find whatever place it needs to be, and it will sit there at the perfect amount because it's a plug-in account. Does that make sense? Awesome. All right. So we're going to move on from treasury stock. We're going to run through some definitions, and then we're going to make a sample stockholders equity. No values, just throwing out what piece is what and how we set it up. So first things first, there's two sources of equity capital. There's two big important sections of our equity account. What's going to be those two sections? Contributed capital. What's contributed capital made of? There is one more account. Not retained earnings. Not outstanding. These are our outstanding. So there is one more thing. Not treasury stock, but I like where your head's going. So what is typically associated with common stock and preferred stock that they kind of share? Not dividends.
Can you repeat that again?
So what account kind of is shared with common stock and preferred stock?
APIC.
APIC or PIC. All right. So what is the other section of equity? Retained earnings, but otherwise known as? No.
Net income minus,
I like where y'all's heads at, but that's not it either. So we got contributed capital. Then we have no. Earned, huh? So there's two sources of equity. So we got our contributed capital and we have our earned capital.
I know.
So let's run through this real quick. Contributed capital and earned capital. The reason why we separate these in equity is because they're both very different ways that we're earning capital that is not through debt. Contributed capital is when people give us money to run our company by buying rather common stock or preferred stock. In addition, due to that, we get paid in capital of excess or additional paid in capital. Basically, this is what has been contributed to us. Earned capital is our blood, sweat, and tears in the company. That is everything we earn. That's why retained earnings is the only thing in there. And you're right. Because we have retained earnings, technically that's folded in for net income, our dividends, our revenue, our expenses. Those are all basically rolled up into the bread of retained earnings. So, does that make sense? Yes? All right. So contributed capital is externally generated, while earned capital is internally generated. All right. So last bit for chapter 11 is we're going to take everything that we've done today and make a mock-up of our stockholders' equity. We won't put any values, but I just want you guys to tell me what we need to put in. I'm going to put the accounts here out of order. And once I do that, put them in what would look like a stockholders' equity. I'll make a shell over here and I will give you guys about 2 to 3 minutes to make that up. Huh? Oh, someone's trying to get into Zoom? All right, thanks for letting me know. Oh, she was? Y'all got let me know.
Well, I wasn't paying attention to it because I thought it was like some like battery notification, and I actually read it.
No, it's because because this was hosting at the beginning, I saw all of the admits into this computer. So I wasn't really looking at the other computer, but I should be looking at that. Sorry about the wait, Sydney. That was on me. We're going over stockholders' equity. So we're making a mock-up. I'm putting all the accounts to the right. They're all out of order. I'm gonna make a bare bone stockholders' equity if you want to do this on the side. And I'm gonna give you guys about 3 minutes once I'm done.
Oh.
All right. Bare bone structure is set up. Put accounts where you think they're going. Make sure to put if they're adding or subtracting to the balance. And I'm going to give you guys, I think like 2 minutes. This is just organizing. And then we'll go over it. Huh? Yep. You want to put these in whatever order you think are here, and make sure, because at least one of these is not going to add. One of these is going to at least subtract.
Oh, yeah.
Are you gonna be making, study, not the study guide, like the questions with like the answers at the end?
Yeah.
Okay.
No worries. So that's going to be sent out tonight,
Okay.
along with as many blue kits as I've made. And that's, I'll be sending out the blue kits also to Ms. Blocker's class as well. So guys, keep an eye out for those if you guys use them. Yes.
Is treasury stock, external or internal?
Internal, because the company repurchased it. So remember, the company holds treasury stock. We are the ones that get it. So there's no external hands on it. It goes right out to external. Something to chew on, for sure. I like where y'all's heads are at. Yes. So I don't know for sure, but I have a good idea, and this is definitely something you might have to make up depending on the questions. Everything that I make you guys work out is 90% something that you're going to do on the test. The only thing that so far I am not too certain on is cumulative versus non-cumulative, but I thought it was good to just run through that just in case. You all right?
Yeah.
Okay. Checking on you. All right, y'all. Let's start off with contributed capital. What's going to be on there?
Preferred stock.
Yes.
And capital preferred stock, and common stock, negative capital and common stock.
When you bought.
All right. Now, question. Is there any adding or subtracting? Are these all adding? Are these all subtracting? All adding.
Monty,
Yes.
just a quick question. When we buy, like, we're the company, when we buy treasury stock, the company would never do APIC for when we buy it, like, to make it treasury stock.
Yes, you would never have APIC because that's going to be, that's the idea. That's our par amount.
Mhm.
Yes. Honestly, because I forgot.
Oh, okay.
So we'll put it on here real quick.
Don't lie.
So I like what we're having here so far. Common stock, I agree with. The paid in capitals and preferred stock, anything else? Or do you guys think we're good?
The last one we decided.
Do you think that's gonna be going up in the paid in capital?
Sure.
It would be. The reason why. There we go. The reason why we have the PIC account up here and not treasury stock up here is because, think of it this way, did we make that money externally or internally? Externally. Because think about it, people paid extra money and we're accumulating that in our PIC account.
So.
Yes. So, question, is the PIC account for treasury stock always going to be positive? Or is it going to be negative? It'd be positive. None of you guys will need to know this unless you're going to intermediate 2 for accounting. So just know that it's always going to be positive. So we got our contributed capital. Now, one thing I do want to make note before we come further, the value of our common stock, is that going to be the issued value or is it going to be the outstanding value? So value of our common stock, is that going to be the outstanding value or issued value? Issued. So even if issued, and we're gonna real quick like look throughout my mess of work. I know, right? Oh, we'll find it again. Don't worry. So even though our outstanding is technically the full external, we involve this in stockholders' equity. Our common stock value for our stockholders' equity is going to be the issued stock shares times the par. And that's our common stock. That will be very, very important to know. Yeah, I found it again. All right. So that leaves retained earnings and treasury stock. We're just gonna throw them off here. And treasury stock. All right, treasury stock. Now, question. I think we could all agree that retained earnings is positive. Treasury stock, is that a positive or negative? Negative. It's a contra equity. So this is the common setup for your stockholders' equity. And with that, we're gonna wrap up chapter 11 with a bow and move on to chapter 3. Any other questions on chapter 11 before we move on? We're not. Don't worry, this is recorded and will be posted up at least by 3, not 3, at least by 5 and at worst 6.
The sound is with it, right?
Yes, the sound is all with it. Have a good one. Thank you for joining. Yep. As well, I think at least Miss Blochter's class, I got these sent out to you. So, yeah, she handed them out.
No, she just handed them out, but I saw her like get them.
Yeah, she got them, but she didn't hand them out.
I guess not.
Here, I was gonna let y'all know anyway, but I do have a stack of flyers and I'm gonna be passing them out to Miss Yeagers on Friday. Final exam group study next week. The times, I did forget to put the place, but you guys already know how to find out that where to check in. Yeah, of course, I'm going. All right.
It's Monday.
So Jaeger's gonna get that on Friday?
Yeah, I'm gonna hand that out to y'all.
Okay.
And I gave them to Miss Blocker to hand out. I'm gonna remind her tomorrow. But yeah. All right. So, you're welcome. Have a good one. Yeah, go ahead. No, please. All right. So we're gonna mildly look at all of our chapter 11 work before we race. So we're now in chapter 3. Have a good one. So we got accrual versus cash-based accounting. So I'm going to make 3 problems, and I want you guys to tell me what the value of that account is. No journal entries needed. What the value is for the cash account. I'm not a cash account. Let's see. For the revenue or the expense. So you're going to tell me how much expense we've technically accrued and how much revenue we accrued for whatever problem I'm putting for both the cash basis and the accrual basis.
You get accountability.
All right, I'm gonna give you guys just a minute. Whether the expense or the revenue values in rather accrual or cash. So this is gonna be the first page of your chapter 3 notes for accrual or cash basis accounting. So accrual accounting is where we accrue things over time. Cash basis is only dependent on the cash value that is handed now. So if I'm not handed cash now, we don't care about it. If I'm handed cash now, we care for it.
So just like the total amount that we were doing.
Don't need to make journal entries. Just tell me the value. So for example, we billed a customer for $1,000. Is that revenue or expense? Revenue. So how much revenue do we acknowledge in accrual accounting? 1,000. How much do we recognize with cash? 0.
Because you only keep track when you.
Yes. You only keep track when you actually get the money. And the thing is too, so one of these guys is not GAAP approved. Which one is it? Cash. GAAP wants us to accrue over time. What are the 2 principles that are so important here? What 2 principles are important to accrual? Revenue recognition, expense matching. Revenue recognition and expense matching principle. So, number 2, we owe our employees $500 but have not paid them. Revenue or expense? Expense. How much per accrual? How about for cash? Perfect. A customer pays for a 6-month subscription for $600. Is that revenue or expense? And we're doing this for 1 month. We're on month 1, or we're on month 2, we'll say. Month 1 has passed. So is it an expense or is it a revenue?
Expense.
Revenue. So for 100 here, how much for cash? 600. The reason why, and this is why I put this one here too. So cash basis works in both ways, where sometimes when we bill, because the money's not there, it's 0, even though technically we're supposed to recognize rather revenue and expense because the expense was incurred or the revenue was incurred. But as far as it goes for when we have these like unearned revenue, right now we're dealing with unearned revenue here, and we have to recognize it every time we perform the service. So for example, for number 3, month 2 has passed, meaning that month 1, we have done and gone over, meaning we have earned $100 of revenue. As for the cash, they just saw 600 and said, thank you.
Wait, what was the 2 months?
So 2 months, I was trying to say, like, I was trying to help get like a idea of a time frame. If it makes it more easier, we'll go 1 month. So
That's why it says
1 month, 1 day.
Yeah.
Any questions on this? Good to see. So. Now we're going to go over adjusting entries, some of our favorites. I bet you guys love these for the project. So I'm going to make a little chart here.
What's that?
Instead of writing out the questions, we're just gonna rapid fire through these since we only have an hour and I wanna make sure we go over everything in chapter 3. So I have a chart here. We're rather working with deferred, accrued, expense, or revenue. So a customer had paid me in advance for my services. Is that deferred or accrued? Deferred.
Is it because it's before?
Yep.
So what was all that we just went over?
What we went over was basis of accounting. Right here is adjusting entries. Here is cash basis versus accrual basis. So these are types of accounting styles. While over here is here is basically the accrual basis, the accrual accounting basis. And now we're going deep into the accrual accounting basis where we're dealing with journal entries and the types. So for example, deferred unearned revenue we know is deferred. What's the little moniker to remember? Does anyone remember it from class? The moniker. Welcome back. We just started in chapter 3. So deferred cash, does the cash come before or after? Before. C before D.
Oh, that thing.
Oh.
So what about accrued? Cash come before or after? After. So
C comes after A. C comes after A.
the reason why we put this cash before, cash after.
Well, why is A before C?
A before
That
C.
makes sense, but so curious.
The-
Because C comes after A.
C after, so C after A. Either way works, whatever format it makes sense for you. For me, it makes sense C before D, A before C. That way it's consistent. But either way it means cash before, and the next one is cash after. So unearned revenue, is that an expense or a revenue? Unearned revenue is an expense.
I thought it was a liability.
It's a liability, but it affects our revenue. So we're gonna run through a journal entry for unearned revenue. How do we accrue unearned revenue? What's a journal entry to accrue our unearned revenue?
Unearned revenue,
Isn't it
debit,
revenue?
and then revenue credit.
So that's how to recognize your service being done.
Yeah, it's like cash.
Is it cash or debit?
Cash.
Right for the wrong way.
And then unearned revenue?
Look at right, except for trying to get rid of it. Well, I think we're now.
Okay.
I'll take that.
Okay.
So is the above entry like recognizing it?
Yeah.
So
And the second one is the adjusting?
yes. So the first one is due is basically the transaction that creates this whole downfall of why we have to adjust. All right. Wages. So I need to pay my employees, but I don't want to pay them yet. Accrued, perfect.
Wait, what was this?
Expense, perfect. The scenario was that I have I have employees I want to pay, but I'm not going to pay them yet.
That's like, it's gonna be paid later, basically.
Yep. So what's going to be the journal entry for that one?
Wages, wages paid.
Perfect. What's going to be the journal entry to pay them back?
Wages payable, debited, and then cash.
All right, depreciation. We're depreciating our equipment. An expense? Deferred or accrued? So, did we already pay for the equipment?
Yeah.
There you go. It's not accrued. The reason why is there ever going to be a cash transaction after our adjusting entry? Nope. Deferred is cash before adjusting.
So the first cash before adjusting that means
Yes. Accrued means cash comes after. So think of it this way. Are we ever going to get rid of our accumulated depreciation by throwing cash at it? Nope. So what's going to be our journal entry?
Depreciation expense, depreciation.
Perfect. So what about a prepaid expense that's expiring?
what?
Prepaid rent is expiring.
That's an expense.
It wouldn't be accrued. Why is that?
Because we already paid for it ahead of time.
Oh my
Yep.
god.
It's deferred, we paid for it.
Prepaid. Already paid for.
It's hard.
So it's when you're buying something, like, you didn't do it before.
Yes. So if you notice this, unearned revenue, we got cash at the beginning. Depreciation, we paid for the equipment already. Prepaid rent, we paid for the rent already. So that's why it's always deferred for those. We'll get some more accruals before we close up, no worries. So what's gonna be the journal entry to adjust?
Isn't it rent expense and then prepaid?
Perfect. All right. A employee had paid, we didn't bill an employee, we billed a customer for services rendered, but they haven't paid us back.
We build a customer, you said?
Yes.
Oh, wait, no. That'd be a cool, right?
It'd be accrual.
Got one.
Expense or revenue?
Revenue.
All right, what's gonna be the adjusting entry?
Accounts receivable.
Welcome. All right, so something to make note of when we're talking about these two, and I really wanna make a note of this, something to keep in mind. If you notice, every expense and every revenue specifically has that adjusting entry with rather that expense or revenues. So when you're working through these, if you're having trouble on the exam, you're able to really pick this apart to figure out what you need to do. So for example, if we know, all right, my unearned revenue, well, revenue is going to be a part of that. Wages, well, expense is going to be a part of that. Depreciation, expense is going to be a part of that. So as we keep going forward, we're able to at least put one account in that spot. As far as deferred and accrued, it just kind of, more than likely, there's not going to be journal entries associated with those, but you do need to know which ones are deferred and which ones are accrued. There are more than just these examples, so make sure you guys are going through your notes. Any questions so far? Perfect.
We've heard it.
So for the last bit, I'm gonna make a problem that I'm gonna give you guys 20 minutes to work on. I'm going to make a unadjusted trial balance. I will give you guys 5 adjusting entries. You will then need to make the journal entries for each of those entries. Use those to adjust your trial balance. And after that, I'm gonna need you guys to close out, use closing statements to close those. Create a new trial, create your post-closing trial balance, create your income statement, retained earnings, and your balance sheet.
I'm sorry, I don't want to talk over that.
That's all good. I'll give you guys, so I'm gonna start working on this, making this up. I'm going to make the adjusting entries first. I'm gonna make the adjusting entry questions first. That way you guys can work on those while I'm creating the trial balance. Because at 3:30, that's gonna be the hard stop for continuing to practice it, because I want the last 30 minutes for us to work through it step by step and any other questions. Does that make sense? Awesome. All right. It's a little bit daunting, but remember, this is something very, very similar to your guys' project. So if you guys were able to get through that, you guys will be able to get through this.
So I think we got a clear what you're hearing. Yeah, they were. Yeah, no, oh, yeah, it's bad. 5,000. It's gonna be 1,000. What's the depreciation expense? Just one credit for it. Oh, yeah, depreciation. I'm dumb. I did like. Reverse. No. Performance of services.
Oh, I can hear you on. I'm gonna computer film my meeting, please. Do the journal entries, and then I'm gonna be making my own trial balance for y'all. But I just wanted you guys to have these problems to work on first. That way, while I'm working on the trial balance, you guys have something to do. All right, I'm gonna make these smaller and putting them down here for now while I work on the trial balance. Right here, I'm gonna. There we go, perfect.
What's the last? We have worked for 1 of the 3 months. What? Because they need performance services. And it's 1 of the 3 months.
So what it means by cash was paid for 4 months of service for your 1,200, what does that make you guys think?
They pay for 4 months of services.
Yes, so did they pay in advance or did they pay after? In advance. So what does that mean? It's a deferral, but also what account are we dealing with? Unearned revenue. So they have earned at this point 1 month of unearned revenue.
Yeah.
So that's what you guys got to think about.
300. Oh, it's unearned. Yeah, I just. Yes, unearned. Yeah, 300. $100.
Oh yeah, no. Sorry, that is a typo. Sorry, I didn't realize that was what the confusion was about. I didn't realize that's what the confusion was about. Sorry about that. I saw 3 months above and that's what.
Oh, those are definitely. I'm making off out of it. That's a lot. Yeah, it's one button.
Oh, this is just.
Yep.
This is why I'm giving y'all like 30 minutes to work on this.
I'm gonna go.
It's all good. This is gonna get y'all prepared.
Yeah, you're right. I'm going to page because we had the same.
I'm adding one more on there because I came up with it and I think it's good to go over.
I'm still on. This is the exact thing you're going through.
Perfect.
I heard.
With them?
And you don't know.
No, wait, that's what they.
ACT is.
Accounts payable, not just receivable, NR, right? What's SP?
SP is salaries payable.
Okay.
Don't worry about this part until we're talking about the journal entries.
Which part?
The big boy over here that I'm working through.
I'm just gonna get the accounts out.
Yeah.
Oh, is this one.
Oh, that's IP.
Interest payable.
There you go. Have a good one.
Yeah.
Oh, actually, I'm running hungry, so I can't focus, but I'm about to join the Zoom. Is that?
Yeah, no, completely fine. Don't worry. Bye. Bye.
No. Yeah, I don't know how that works. Yeah, I'll have money at 15 minutes. Here's the thing though, I just don't have money. I figured out to go. Wait, James, everything on the line?
Yeah, it's on here. RE.
What's the
That's what I was thinking. Bye, Monty.
Bye. Have a good one.
Yeah,
It is.
I understand. No. Forward. Oh, I see that. Sorry. I can just. Thanks.
Oh, down here is rent expense. That's what I put. These are all expenses here.
Okay, so does that mean that's hours? Alright.
Yeah, salaries expense.
Yeah. It is.
All right. Trial balance is up. Everything balances.
Wait, is it supplies expense and salaries expense?
Oh, wait, I forgot it. Yeah, supplies expense, salaries expense. So I made the space so small, so I had to really shorthand. Don't worry about the trial balance, worry about the adjusting entries. And then we can move over to the trial balance. We'll run through that. And then I'm going to leave you guys to do the financial statement. So I'll give you guys, what time is it? Oh, I'll give you guys like 3 minutes for the adjusting entries. If you guys want to try to go forward and fill out the trial balance, feel free. And then from this, I'm gonna have you guys do all the financial statements, closing entries, and balance sheet.
What?
So I'll give you guys 2 more minutes.
On the briefcase, right, is that 12,000?
Yes. Here, I realize the Zoom cuts that off a little, so we'll put that down.
Okay, so what's the middle and what's? like, the
So
middle?
the middle's gonna be where we're gonna be putting some of these adjusting values. And the right is gonna be what the adjustment is. So instead of doing journal entries, we're gonna put in debit columns and credit columns where these are. I would like you guys to do the journal entries if you can, but if not, that's fine as well. Just to save time though, we're just gonna run through that. And then we will focus on a lot of the journal entries for things like for the closing trial balance and all that, since those are more unfamiliar, while these, you guys have seen these adjusting entries throughout the year. So throughout, like, depreciation is gonna be chapter 8. We got chapter 9 for those liabilities.
We went no payable 3,000 on that?
Yes, note payable 3,000.
Oh, okay.
So do we
Yes.
do anything with the middle?
Yes, if you want to start putting values in there to make your adjusting trial balance, that's what the aim is for. So for example, employees earn $10,000 for a 5-day work week. They only work 3 days out of the week. So what are we adjusting for? Wage expense, wage payable, how much? 6,000 each. So we got, it's salary expense here. We're gonna debit 6,000.
Okay, so we're just adding. the numbers on the
Yep.
entries. And then at the end, the adjusting with everything else.
Yes. And what was your question?
It wouldn't be oh, sorry, for number 1, it wouldn't be salary.
It is salaries. It's salaries or wage. It doesn't really matter either way. I believe you're gonna get points either way. In the real world, it matters a lot more. But as far as this goes, as long as you know we're paying our employees, that's what's happening. Yes.
14,000 go to revenue or salary?
It's for revenue.
Okay.
So all of our accounts here is cash, supplies, prepaid rent, equipment, account payable, unearned revenue, salaries payable, interest payable, note payable, common stock, retained earnings, dividends, revenue, salaries expense, depreciation expense, retained earnings, supplies expense, and interest expense. I do realize I forgot one more account on there, but we'll figure that out when we start running through this. I'm gonna give you guys one more minute. Have a good one.
Oh. That was the one account we forgot.
You guys figured it out?
Yeah, I gotta rewrite this.
I know. I feel the same way. Yep,
Not on there.
it's not. So we're gonna add it to the bottom. Because
But where would it go theoretically?
theoretically, it would go here. But I'm just gonna toss it here.
You know, if I find a file.
Yeah, but it should go here.
So it goes
So
for.
we're gonna start running through these now. So we already have number one. So our equipment was bought at $600 with a $1,000 salvage value over 5 years of life, recognized 1 year. So what is our journal entry typically for depreciation?
Depreciation expense, 1,000. Depreciation 1,000.
Perfect. And do we all understand how we got there? Well, we're not gonna put it there actually, because that'd be confusing. How we got there was by taking 6,000 minus 1,000 divided by 5 equals 1,000. All right, number two. Prepaid rent was originally bought $12,000 for a year, recognized 3 months. So, not 4,000, 3,000. The reason why 12, put it here, 12,000 divided by 12 equals 1,000 times 3 equals 3,000. So we got rent expense. What did I? All right. So now we're on to cash was paid for 4 months of service for 1,200. We have worked for 1 month of the 4 months. What's happening?
Did service, 300, service payable, 300.
It's not service expense and service payable. So this is a case where someone has paid us money up front. We've already got that. So what typically goes with the first journal entry when we're handed that money?
Okay.
Cash and unearned revenue. So we've now done 1 month out of the 4 months. So what we're doing here is taking the 1,200 divided by 4 equals 300. So we will, what's our journal entry? What's our journal entry? Or number 4. Now, we debiting or crediting?
Debiting.
So we debiting unearned revenue. And what are we crediting?
Revenue.
Yep. All right. Number 5, our note payable for 3,000 has interest of 100 accumulated.
Expense, definite 100.
Perfect. Last one, number 6, we had $200 of supplies at the beginning of the year, bought $3,000 and had at the year end 500. What's happening? So this is similar to your problem, except more steps. And technically I have part of the answer here. Your supplies?
Like, $1 supplies and some beginning. Probably 300.
we bought 3,000, 3,200.
Okay, we buy 2,000 and we ended with five.
Yeah, no, we did, 3,000 minus 3,200 minus 5, it'd be 2,700.
Perfect. Now what's my journal entry?
2,700.
Supplies expense, 2,700, and then the other one is it? Think, right?
Yep.
Right? Payable? Oh, yeah, supplies, yeah.
Yeah, because this actually should be not an X there.
What was number 5 again?
Yeah, of course. So number 5, our note payable of 3,000 has interest of 100 accumulated. What's gonna be our, huh? Oh, what did you do for the 2,700? Right down here. So this is how we got our 2,700. At 3,200, we have to figure out how much we lowered to get to 500 because this is our main goal. So we know we have to minus 3,000. Oh, did not mean that. So we end the minus 3,200 with 500 to get 2,700 because 2,700 minus 3,200 equals 500. Yes.
What was the general entry for 5?
So 5, if we're dealing with interest, what do you think?
Interest payable and
Perfect. Sorry, I had to drag it out of you. We got those numbers specifically from number 6. We had 200, which was our beginning value of supplies at the beginning of the year. We then bought 3,000, and adding those together equals 3,200. And at the end of the year, we had 500. Oh, you thought that was 5? That's all good. Sorry, my handwriting's terrible on this thing. So we're gonna do only a few of these and then together, then I'm just gonna start filling out this whole sheet for y'all, for you guys to focus on the last bit. At 3:40, I'm going to start running through all the financial statements and everything. So I'll give you guys about 10 minutes to work on it. But real quick, was there anything we did with cash?
No.
Nope. So it sticks at 1,500. Have a good one. What about supplies? What is supplies now at?
500.
500, debit or credit?
Debit.
All right. I'm gonna oh, wait. We forgot. Did we forget or did I just forget to put it?
Oh, wow.
All right. I forgot to put, bring this one down.
Dumb.
No, you, I figured it out. Have a good one. So prepaid rent, is that sticking at 12,000 or is that changing?
Changing.
What's it changing to?
9,000.
Perfect. All right. Start filling this out. Make your financial statements, your closing entries, and your balance sheet. We'll reconvene at 3:40. It was this thing happen. Yes.
Attention, room equip.
Yeah, we got like 3 more minutes.
Okay, she's one, if she gets one.
If anything, I'm sorry, I'm like running off right now. I don't think so. So, oh, I didn't get you. Because you're gonna put it all over there, like that, say that might be. I report these.
I'll send her your finance and closing.
Oh, wait, I
And
think that's
the final, yeah.
Is that her?
I'm going through the whole thing.
Hi. Welcome in, we're working on the last bit. I made a trial balance. Here, she got it. I made a trial balance, we need to be adjusting entries. What we're working on right now is just, what I want y'all to do. Take the take the adjusted trial balance we have to the right. Create your closing entries, create your financial statements, and then we're gonna be working on, and then finish the balance sheet. I think we only got like 5 more minutes, 5 or 6 more minutes, and then we're just gonna run through it because we only have like 20 minutes. I want to make sure we get over this, but I have, this is all recorded, and it will be posted up by 5 p.m. today. YouTube is right down there. Thank you.
So once we're done with this, what else?
So, you already done your closing entries?
What you were doing the whole thing?
Yeah, we're doing the whole thing. We're stepping from A to B. No, A to Z, because I have to back your tests.
Yeah, so after this, do you want us to go to
Closing entries. You need to do closing entries. You need to do your income statement, your statement of retained earnings, and balance sheet.
But income statement. Retained earnings.
All your financial
I've
statements.
got my income statement, retained earnings,
Balance sheet.
balance sheet. So balance sheet.
Cash flows next week.
Yeah.
So do I, so it's about retained earnings, but now.
So, if you do your balance sheet then.
Something got that over.
Basically, or if you want.
At the Lord.
Yeah, so definitely, you make the balance sheet and you update it with your new retained earnings.
Oh, so I did the same thing, so just make this bigger.
Anyway, we'll go through it. So you've already done your income statement and your statement of retained earnings,
Yeah,
and you've done your closing entries.
not those yet, cause,
Yeah, close your accounts and then make your balance
we'll see what happens. How about that?
sheet. For a lot I know, the accounts we've gone through is cash, supplies, Texas small. I'm gonna actually,
It's gonna be a.
this is the whole thing. We got cash, supplies, prepaid rent, equipment, accounts payable, unearned revenues, salaries payable, interest payable, note payable, common stock, retained earnings, dividends, revenue, salaries expense, depreciation expense, rent expense, supplies expense, interest expense, and accumulated depreciation, we forgot, so we put it at the top.
Oh,
So I know it's a lot. You kind of came in at like the very end of this.
It's gonna be debit card interest. And then some rent expenses. We don't have that all. The rest is the word. Expenses were told us. Hey, Monty, I got a question.
Yes.
I really don't feel like writing out all of my expenses for the closing tax credit expenses right now.
Yeah, no, that's a valid thing to do. You'll have to ask your teacher if you can do it on your exam though.
I'll just do it on the example for that, right, I just want to do it.
Yeah, go ahead.
What? Like forward.
Yeah.
Yeah. It's not. Sorry, what doesn't? Okay, what doesn't? Great, great, and wait, what can you do? So once we have this. Liabilities, so that's what. Okay. 6,000. Okay, so,
All right,
you know, what can I do?
we're gonna start running through these. Real quick, I don't know. Are you Mr. Harding or?
I'm gonna do.
I'll let you pass it down and I can some here, but I can wait. So this is also stuff that's gonna happen next week. the final statement. And, make sure.
Yeah,
that you know,
because-
there might be some important stuff.
Yeah,
Okay. So, let's start running through these. We're gonna first start off, let's see. With our post-closing trial balance, I mean, not post-closing trial balance, closing entries. And we're going to do these side by side. Some of our financial statements. So we're gonna first focus on the income statement. What's the income statement?
Revenue minus expenses,
Revenue minus expenses.
and the income is, $1,000.
So we're gonna walk this out first. But I appreciate the enthusiasm. So what's our revenue?
14,300.
Have a good one. So we got 14,000. 300. All right. That's all of our revenue. So we minus our expenses. What expenses do we have?
Salary expense, depreciation expense, supplies expense, rent expense, interest expense.
Salary, supplies, depreciation.
See, that's why I'm lazy, it's put expense.
I can't be lazy. People who look back at this need to see what's happening.
That's true.
And.
So we got all these added up. 800, welcome back.
The expenses are 12,800.
Yep. So we subtract 14,000, I'm gonna make that better for. It's driving me insane. 40,300 minus 12,800. What was that net income?
1,500.
1,500. All right. So what's that in closing entries? What is that in closing entries speech?
Summary?
Income summary. So is that debited or credited with revenue?
What,
Revenues debited.
Revenue is debited.
Income summary.
All right. How are we dealing with our expenses? Debited or credited?
Debited. I mean credited.
Credited. Now, what are we debit? What are we debiting?
Income summary.
Wait, you make the first round. Wait.
Oh, you are talking about the closing revenue. Yeah, they don't.
All right. So now we're going to go over to the statement of retained earnings.
Yeah.
What is the formula for the statement of retained earnings?
Getting retained earnings plus net income minus dividends equals retained earnings.
Yeah.
Was I close?
You were great. All right. So what was our beginning retained earnings?
18,000.
Yeah.
So we got 18,000. All right. What else?
Net income adding 1,500.
What about dividends?
6,000.
All right. So what's that going to look like over here?
What?
How's that going to look like in our closing entries?
Income summary. Debited.
And summary debited.
Retained earnings credited.
Or how much? Yep. So to kind of look at this, to put it into perspective, here's our income summary. We credited 14,300, debited 12,800, which is essentially our income statement. At the end, have 1,500. So what's the last bit here?
Dividends.
Dividends, debit or credit?
Credit. And then retained earnings debited. 6,000.
And again, just to kind of give it, to see how this is going, we had 18,000 at the beginning. We added 1,500. We then took away 6,000. Do you think we made good business Do you think we made good business decisions this year? No. We got a little net income, but we took a lot of dividends. So we have two of our final four financial statements. We're not going to do a statement of cash flow, obviously. We'll really focus on that next week, but we do want to make our final balance sheet. So I'm going to actually move these so I can see this side by side. So we're going to make our balance sheet. All right. So what accounts are we adding? And are they in a very specific order?
Yes. Current assets, long-term, wait, long-term?
Long-term.
Long-term assets.
Actually,
current liabilities.
I'm making a trial balance by accident. Let me make a better balance sheet. All right, we're gonna focus on our current assets first. What's our current assets? Cash.
Receivable,
Supplies, equipment,
Is equipment a current or a long term?
I think it's long-term.
Perfect. What about, you're missing one,
Supplies.
prepaid rent,
prepaid rent.
and
Oh, I
some
didn't see
intellectual.
We did not have any accounts receivable, so I fell for that. But no, good on you for knowing though. Good on you for knowing. You do need to know that account receivable is a current asset, so I'll give it to you.
So confused.
We didn't have, on our trial balance, we didn't have any account receivable.
To be fair, it's a lot of accounts.
Oh, it is a lot of accounts, and I was just kind of running with everything I knew. Apparently, account receivable was not one of them. No. So what's our long-term assets?
Land, building,
You're not wrong. All right, does equipment come with a buddy?
a team, like, appreciate you.
80. 80.
I'll wait for someone to go.
Are we adding or subtracting?
Subtract.
Perfect. Why is that?
Contract.
Contra asset. So now liabilities. What's the current liability?
Supplies payable.
So supply payable?
Yeah.
You mean salaries payable?
Oh, yeah.
Right.
And then accounts payable on there. It's not on the. It's not.
Oh, yeah, you're right. Oh, it's for this thing, right?
Yes. You're missing a couple, well, you're missing
Interest.
For liabilities?
interest payable. Yeah,
Okay.
Unearned revenue.
there you go.
And then long term,
Notes payable.
yeah.
Yep.
That's it, right?
Yeah.
Okay, now that I know now that I understand, I can answer questions. So, equity, I think it's,
Yep, equity time.
more,
What's in our equity?
all of our expenses.
Is our all of our
Wait,
expenses
no, not on the balance sheet,
not on the balance sheet? Expenses aren't on the balance sheet. What else is not on the balance sheet?
Dividend,
Dividends is not. What else? Retained earnings is on the balance sheet.
Oh, that's what I thought that's what that was the question.
Now, is retained earnings gonna have the value that was there, or is it gonna have a new value?
new value, 500,
All right, what else is in our equity?
and,
Common stock. So I wrote all these totals. What's the most important totals that I need to know?
total asset, total liability, equity.
There is very well a possibility this doesn't add up because I made this on the fly, but we like to hope.
We pretend it did, that's the answer.
Well,
Imagine we're off. Having a lot.
I think we're off on liability.
Let's see. 7,000, 10,000.
Oh, no.
Hey, we got up.
But that's cool.
This is how you do a good balance sheet, y'all.
Good job, Monty.
Thank you. I've improved. Yeah, we're gonna. And that's how you double check yourself on a good balance sheet problem, which I've surprisingly apparently did. And we just made time, 2 minutes till the study session ended. Is there any questions? I also don't have any appointments till 4:30. So anybody needs to ask anything? Yes.
I missed at the start, because I was here for like an hour.
So what you missed was just basically the first couple of notes talking about the company, knowing the advantages, disadvantages, knowing what common stock and preferred stock can do. Basically going through the first part of the chapter 11 notes.
Okay, so.
Are you taking appointments tomorrow?
I am taking appointments tomorrow, 2 to 6.
Good. I'll see you then.
See you then.
Practice problem.
Hey, Monty, I have a question. Do you have like a small towel that you have on you?
Small towel.
Like, maybe, so.
I do not, but you can probably get paper towels from the bathrooms just across the way. You're looking for towel?
Yeah, like a towel.
Sorry, I do not keep towels on me.
Well, looks like I'm going home today.
My apologies.
Well, I did laundry last night, but my roommate's using the dryer. And like 11 some at night, like, yeah, I'm going to bed.
All right. Good luck to the exam to all of y'all. I'm gonna be hunkering over here and probably sending out the blue kits right now. And I'll hopefully be making more by tonight. So you guys might get just an extra email saying, hey, here's some extra blue kits. Yes, of course.
Wait, so yeah, so you said the other one's out?
I will. Yes, of course. I'm gonna be I'm gonna be passing these out on Friday too, so be ready for another.
Okay, that's fine.
Bye, Monty.
No, do you need paper as well?
Actually gave it to.
Oh, nice. It does, completely forgot to put that it's in the library. Just do the same process we did today. You signed in and you're rolling.
Wait, we got one.
Yeah, of course.
What's the paper that scares me?
What's the paper that scares you? This
Yeah.
paper?
Yeah.
Oh, no, this is just saying that group study next week, the times.
I'm assuming it's just gonna be the usual.
It is the usual, but it gives me an excuse to go into people's classes and hand them out.
Okay, I'm not gonna
So
find it.
you guys typically I don't need to do because I'm embedded in your class and I get to directly text message you guys. But otherwise, I like pop into everyone else's class to be like, how you doing? Because I know you came in here late, so
Well, I was studying with
Samara,
yes.
and then she had to go, I'm guessing.
Yeah.
It's all good. Anything you want to work on or anything?
I don't think so. I'm gonna pretty test this tomorrow. I'm gonna do all the stuff that you send out.
No worries.
Thank you.
Yeah, of course. I'm
You
lucky.
don't know how tempted I am to take a ride.
Don't want they will get mad at me.
You don't understand how tempted I am.
Is it?
It's leg day.
It's leg day.
Yeah.
Well, they're not even like they're not rags to soak water up
Oh,
though.
you know my answer could be?
What?
I could just have a bean in my pocket, so the answer I was like, pull a little bit. You know, no, tomorrow's my rest day, right? So I'll just work out tomorrow, do my rest day today.
Yeah, just swap them up a bit. Swap them up.
Yeah. Alright, see you, Matthew.
See ya.